Thank you, Jess. Okay, good morning, everyone. As Jess said, focus today is going to be pension legislation. My main focus is going to be on the changes from April 6th this year. So, of course, the spring budget brought in some quite big alterations to how pensions are taxed and the relevant allowances. So I just want to make sure we run through those in a bit of detail. I will be giving context to some of the previous legislation and the kind of general continued legislation just for context, but more than anything, I want to run through the changes from the 6th of April. For context, risk disclaimer as always, of course this is information, not advice, so it can't be constituted as individual advice. This is information based on our understanding of the HMRC rules as of today. I say as of today because one of the themes we'll be discussing potential changes and of course the mass changes we've had in pension legislation really over the last 15 or so years. The slides itself, again, I expect this will probably take 20 to 30 minutes for me to run through. As just mentioned at the end, I'll run through your questions, so feel free to put them into the Q&A chat section. Just don't be surprised if I ignore you until the end, because I may actually answer some of your questions as I go, and then we'll come back to it all at the end of the presentation. So as by way of agenda, as I mentioned, I'm probably going to focus a bit more heavily on the post 6th of April changes, specifically looking at the annual allowance, the money purchase annual allowance, the tapered annual allowance, and the lifetime allowance, all of the allowances. We'll consider things like changes to pension savings for those who've previously had to opt out, and I will at the end touch on the future. Of course, I've not got the crystal ball or the insights to the cabinet meetings that are taking place, so this is based on our understanding and our research of what's going on in the market, but of course the advice we give will always be based on our current understanding of the legislation. So I thought I'd start you off with some very thrilling facts about pension schemes, which I think are quite interesting and actually sets a bit of the theme for the discussion I'll be going into in terms of why they've potentially made some of these changes. And really it just does give context to sort of the broader picture on how pensions fit into our fiscal system. So the first thing noted is in terms of income splits. There's a lot of news, of course, on media outlets with regards to state pensions and the risk of them not being here for our future retirees, but I thought it's quite interesting to see that the actual split of pension income for the average individual in the UK is about 51% from their state pension and 49% from their private schemes. So that would dictate the average income for a retiree is about 20k, given that around 10 is the state pension in today's terms and the other 10 from their private schemes. Back in 2021-22, the statistics showed that only about half of working individuals actually opted into personal pension schemes and workplace pensions, but that has now gone up to 88%, which is very positive off the back of the auto-enrolment rules that were introduced recently. In terms of cost on pension schemes, this is one point I thought was particularly interesting, was the actual cost relative to GDP for pension tax relief. So I'll come on to pension tax relief and how that works for those who need a reminder or are unsure on that in a moment. But effectively, the cost of the government providing us with tax relief via self-assessment and gross uplift on private pension contributions is equivalent to about 1.8% of GDP. I personally thought that might be a bit higher. So I thought that was an interesting statistic, including national insurance relief for things like salary sacrifice. That works out to be about 67 billion pounds. I'll be coming on to the annual allowance throughout today, and again, just for context, in the 2021 tax year, about 41,000 individuals breached their annual allowance, which is relevant for later on in the presentation. Going back to my GDP statistics, again, an interesting one when we're thinking about the lifetime allowance in the future, but the lifetime allowance charges for 2021 was reported to be less than 1% of our fiscal GDP. So again, all statistics which sort of feed into the context of why we've had changes in the last year specifically, and of course just plays into a bit of the consideration on what could be ahead in the future. So kicking off from the top, the pension annual allowance. Effectively, there is no limit on how much an individual can pay into a pension each year. the limit is applied to where you can get tax relief. So really, there's not much point in going over the annual allowance because you're not going to get the tax relief and you pay the tax on exit. So traditionally, we would refer to the annual allowance as the actual limit on pension contributions. Again, something that's changed from the 6th of April is how much that annual allowance is for the standard earner. Previously, it's been £40,000 for really the last 15 years, but that's now risen to 60. There is a tapered annual allowance which comes in, I'll be feeding on to shortly, for earners earning over £260,000 a year. But for anyone earning sub 260, the annual allowance has gone up by that £20,000 limit to £60,000. It's worth noting that the rules for the pension annual allowance apply as a cap of the annual allowance or your earnings. So, for example, whilst the standard annual allowance may be £60,000, that will only actually be applicable to an individual who's had £60,000 of relevant earnings. So, for example, if an individual had £50,000 of earnings, that would be their lifetime allowance cap. The reason being, you cannot get tax relief on money that you've not paid tax on. So effectively, the way I would explain it is you have an annual allowance. However, if your earnings are below, treat that as your allowance for tax purposes. Again, contextually speaking, it's important to note that the annual allowance is not lost on each individual year. So you can carry that forward. For example, if you had £10,000 annual allowance remaining from 22-23, you could carry that into the 23-24 tax year. Of course, tapered annual allowance is something I want to stress in a moment, but before moving on, it is worth noting the money purchase annual allowance as well. And this is an annual allowance I think is slightly misunderstood. So if you have taken tax-free cash from a pension scheme or a pension commencement lump sum, you still have a full annual allowance. However, if you've taken income flexibly from a pension scheme, you fall under the regime of the money purchase annual allowance, or the MPAA. And effectively, taking income flexibly from a pension scheme is only things like a flexible annuity or a flexible drawdown. Taking from a lifetime annuity that has a guaranteed rate, for example, or a defined benefit pension actually doesn't fall into the rules. So if you're in receipt of a DB scheme, for example, but you're still working, you're still paying into a scheme, you wouldn't fall under the MPAA rules. However, if you have taken income flexibly, you are limited to how much you can save. Again, if you are not earning, this rule would be different, but the money purchase annual allowance has risen from £4,000 up to £10,000. So a slight benefit for those who are already in receipt of flexible drawdown. Just before I move away from the screen, I apologise for the typo at the top. Annual is clearly a tough word for me to spell when I'm writing these, so apologies for that. Okay, with correct spelling of annual, we'll move on to the tapered annual allowance. So again, to add confusion, this has been one bit of legislation that has changed drastically in the last couple of years. Even when I was putting this together, I was really having to rack my brains as to the years they made the changes. I think specifically because one of them came in the period of COVID lockdowns in April 2020, where of course everything was rife with change, so it was easily missed. But effectively, the tapered annual allowance is a restriction to the annual allowance contingent on one's earnings. So introduced in April 2016, the tapered annual allowance came in affecting earners who had over £150,000 of income. There are some slight nuanced rules on how that income is derived. I'm going to keep it fairly simple today and use the relevant earnings, so 150,000. You may sometimes see that reported as 110. If anyone has any questions on that at the end, I can come back to it. But for simplicity, I'm going to take the 150 starting level here. Effectively, the rules were, if you earn over £150,000, for every £2 you earn over the threshold, you would lose £1 of your tapered annual allowance. Anyone earning over 210 and above had a cap at £10,000, and that was a kind of fixed level. So if you earn 210 or you earn 2 million, you would be capped at £10,000 a year. As I say, April 2020, the rule change increased the threshold income up to 240,000. So we had that £90,000 benefit rise, and the cap was also increased on the upper end. So the rule now being, if you earn over £240,000, for every £2 you're over, you lose £1 of the 40k then annual allowance. Anyone over 312 was then capped at £4,000. So again, a slight rule change on the higher end of it there. As of April 2023, again, the rules have now changed, the threshold income level now being 260. So for every £2 you earn over 260, you now lose £1 of your £60,000 standard annual allowance. Anyone earning over 360 as the upper limit now is capped at £10,000. And I would just stress annual allowance payments are relevant for both our contributions as individuals and company contributions. So employer and employee both feed into this. Pension transfers are exempt. So if you move money that's already in a pension scheme, it doesn't form part of the annual allowance. Just to illustrate that in a bit more detail, as per the current tax year, the 23-24 tax year, this breaks down how the annual allowance would be tapered for earners in a couple of different brackets. So for visuals, for example, if you were earning £300,000 in the current tax year, we would have our standard annual allowance of 60k, and you would have a reduction of £20,000 down to 40,000. And that's because we're taking the £300,000, deducting the 260 threshold income. That £40,000 divides by 2 and is deducted from the 60k limit. I'm sure I've oversimplified that in my explanation. So of course, if you want to go through an exercise, and we would always recommend this, to consider how this affects you personally, of course we can do that for you, but just for generic numbers, hopefully this is just a nice visual. The most important thing showing here that anyone earning over the 360 and above, you know, the 10k threshold remains. So anyone over that threshold, £10,000 is the number to bear in mind. So in terms of ongoing pension savings, the fact that we've had the increase to the annual allowance and a bit more room in the contribution brackets for those in the higher earning additional rate brackets, I think the pension saving is sort of back on the table. If I take, for example, some of the bigger employers that we've worked with in the UK, we have seen quite a few companies do things like increase individuals' income. So PAYE increases to counter the fact that they've had to opt out of pensions. You know, they might be over the annual allowance, for example, based on their earnings and their contributions. Therefore, they've had to opt out and receive higher income to replace that benefit. Other companies have done it by things like share schemes. So effectively, there was this bracket of individuals who had to opt out of pension schemes to avoid annual allowance charges, who now could potentially come back in. So if you were in that bracket, you're earning the 200 to 300k limits for the last tax year, I would strongly recommend looking at your contributions with your advisor and just considering whether you could opt back in. Additionally, I think that ongoing pension savings are sort of back on the conversation topic anyway for a lot of individuals looking to save for the long term, on the basis that we've seen broader tax changes to the system on general investing. So ISAs remain unchanged, but for anything that you have non-tax wrapped, meaning invested in directly held shares, trading accounts, general investment accounts, the capital gains tax and dividend tax treatment is changing. This is just on the allowance side. The actual tax rates remain the same, but at present, the capital gains tax limit for the tax-free gains you can have in a tax year is £6,000. That falls to 3 on April 6th next year. And for dividend tax, again, our allowance was previously £2,000, but that's fallen to 1,000 this year, 500 next year. So broadly speaking, given those changes, I think thinking about your access needs to your assets is more important than ever. Of course, filling ISAs is a no-brainer for money that you want to keep flexible, invested, but accessible. However, for those longer-term assets, I think pensions are now back on the table for a larger bracket of investors. It is worth noting within the broader discussion here that the access age for defined contribution pensions is changing. If you haven't hit 55 by 2028, your earliest access age is going to be 57. Of course, this is something that is subject to change, so we just have to report on what we know at the moment. Pension savings are, of course, back on the table because of the annual allowance points I've mentioned, but it is also worth noting that we've got the changes to lifetime allowance to be discussing here. And again, this is quite a detailed and nuanced area of financial planning, but for many individuals, they were opting out of pension schemes based on the value they had in total pension assets to avoid breaching a lifetime allowance charge. But it is now worth noting that that is being abolished, and I'll come on to more details shortly. Again, for context, I think it's just worth reminding on the pension tax benefits within all of this and thinking about how savings can be beneficial for you as an investor. And I'm showing you here two different examples. The first column we can see here is the example of pension savings for a higher rate taxpayer, so someone paying 40% income tax relief. And I've taken a net contribution, so money that leaves their bank account, of £8,000. By contributing £8,000 to said pension scheme, the higher rate taxpayer will receive £10,000 into their pension pot. They will get uplift effectively equivalent to 20%. So their £8,000 automatically goes into the pension as 10. On their self-assessment for the relevant tax year, they will then log that they have had a £10,000 gross pension contribution, and they will receive a further 20% tax relief, in this instance equivalent to £2,000. And that's because they've had 20% relief at source, they're a 40% taxpayer, so they're bridging that gap with an additional 20% of income tax relief paid via a refund or a rebate. The mechanics of that is that effectively a personal pension contribution stretches your basic rate band. And it is worth noting that if you do have other taxes due on self-assessment, for example, tax on rental properties or tax on things like interest, that will come off this figure. So you won't get the £2,000 and then have a bill. They will kind of work behind the scenes to effectively reduce your tax due in some instances. So the total tax relief, of course, for our high rate taxpayer is 40% as per their marginal rate of income tax. So they've got £10,000 in the pension scheme, but the effective cost has been 6. The same applies on the basic rate level. And I've given you here what probably looks like a really specific number of a net contribution. And I'm showing you this just for a bit of broader context for non-earners. So if you're not earning, you can forget everything I've just said about the annual allowance, because we are capped at either our annual allowance or our relative earnings. However, for those who don't have an earned income, and it's important to note that for pension contributions, earned income is PAYE income, as opposed to it being anything on dividends, rental income, things like that. So if you don't have any relevant earnings, you can only contribute a gross figure of £3,600 a year. So in order to get that 3,600 into the pension scheme, you pay in 80%, which is this lovely round number here of £2,880. Automatically, on contribution, 720 is added to give us that gross figure of 3,600. That's your annual allowance as a non-earner used for the year. Of course, there's no tax relief via self-assessment due because you don't have any earnings to claim against. So hopefully going over a bit of old ground there for many, but useful nonetheless, just to highlight the merits of pension savings from a tax contribution perspective. I just want to take that through then and think a little bit about how you're taxed on exit, because a common question we get when we're advising on pension contributions is, well and good, I'll get my contribution tax relief, but what about the tax on exit? And of course, pensions, as per the current system, allows us to take 25% tax-free. This is referred to as a pension commencement lump sum, or a PCLS, and the remaining 75% is taxable as income. So under the assumption that our higher rate and our basic rate taxpayer are over the pensionable ages, they're over 55 in current terms or over 57 in 2028 terms, in theory, they could take that money straight back out again. Of course, we have to bear in mind that if they are taking pension income flexibly, they are now limited on the money purchase annual allowance. So for the sake of argument, my example will be someone who's paid in, retiring, and is now taking out the money. So our high rate taxpayer has got a gross pension contribution of 10k. As we've already said, effective cost for them has been 6 based on the tax relief they've got on self-assessment and on gross uplift. If they were withdrawing that entire £10,000, they would get 25% of that, £2,500 tax-free. Taxable income would then be £7,500. Again, if I'm using a high rate taxpayer example, you know, let's say, for example, this individual has a fantastic defined benefit pension paying them, you know, £50,000 already, all of their £7,500 taxable income would be at the 40% rate. So I think quite a rare scenario in the grand scheme of things, but if they were liable to tax at 40% on this 7,500, that would equate to a £3,000 tax bill. Of course, pension drawdown is taxed at PAYE, so it's taxed at source, so no self-assessment drama for this investor in this instance. But effectively, less their tax, their net withdrawal would be £7,000. Of course, we've already discussed that they've had 4K tax relief at source, so effectively, even from washing the money through the pension, they've made a total tax saving of £1,000, which is equivalent to 12.5%. Of course, ignoring any growth, also ignoring any losses, it's quite a good tax trade there from the outset. Similarly, the kind of tax reliefs are seen for the basic rate taxpayer. In this instance, I've assumed that this investor is retired, so they are capped at their 3/6 annual allowance. And again, they'll get 25% of that 3/6 tax-free. Assuming no personal allowance, the residual 75%, 2,700, is taxable at 20%. So on their 3,600, they would get a net payment back of 3,060. So for this individual, even washing through £2,880 today, withdrawing it tomorrow as a net payment of 3,060, they've made £180, which is an equivalent percentage of about 6%. So for those who are retired and think I'm suggesting really random numbers to you each year for what we should move into pension schemes, there is method to the madness, and hopefully that's quite well illustrated here. Of course, again, any questions on this, please let me know, but it's always worth understanding this in the broader context, and of course speak to your advisor to get your individual tax calculations on all of this good stuff here. Okay, taking us over to the lifetime allowance, which is an area I'm going to have to be very careful on discussing, because it is so subject to change at the moment. And I think a very popular question I'm going to get at the end of this is what's next, and I will try and tackle that to the best of my ability. But it's just very worth noting that the lifetime allowance is pretty much a political tennis ball at the moment. It's very up for grabs in terms of what on earth is coming next. But broadly speaking, the lifetime allowance was introduced on the 6th of April 2006 on what we call A Day for pension schemes. And this was effectively a very monumental date whereby pension legislation was normalised. For example, pre-2006, a pension scheme itself could decide how much tax-free cash they give you, which was lovely, but of course very hard to actually administer on the HMRC side. So the fact that more schemes were closing defined benefit structures and moving to defined contribution models of pension saving, it facilitated the requirement for normalising the rules, therefore introducing things like the annual allowance, the lifetime allowance, and normalising the tax-free cash rules. So effectively, the lifetime allowance, very simply, is a limit to the amount of money you can have in a pension scheme before you pay a lifetime allowance charge. The charge, when it existed, was 55% for lump sums, 25% for ongoing income. I'll give you an example of what that looks like in a moment. However, as of the spring budget, the lifetime allowance has been abolished. Fairly surprising news, I think, for a lot of individuals and us in the industry. You know, we felt like there would be an increase to the limit. You know, previously it was just over 1 million, or 1 million indexed from 2020, but we thought maybe we'd go up to 1.5, 1.25. I was nearly spat my tea out when I found it was going to be abolished completely, but nonetheless, the rules are at the moment the lifetime allowance is being abolished. Technically, it's only being officially abolished on the 6th of April 2024. But at the moment, the mechanics are still operating, but just with 0 rate tax charges. So what that means is if you were taking money out of a pension scheme, we would still have what we call the benefit crystallisation events to test for the lifetime allowance. But even if a charge is due, it would be at a 0 rate. So slightly complicated. Again, it's a bit more of a mechanical piece of information that you as investors and clients aren't going to see that, but it's just a bit more of a logistical point, mainly from our end and the provider end. It's still technically with us, just at the 0 rate. It's worth noting as well that the lifetime allowance didn't just limit how much you could have in a pension scheme, but it limited how much you could access as a tax-free lump sum, or the pension commencement lump sum, to use its official title. This was something that at first it wasn't very clear what they were going to do with, to be honest, but Clarity has shown that they are capping the amount you can take out as a PCLS or a tax-free cash at 25% of the 2022-23 lifetime allowance. So the lifetime allowance on the 5th of April was this number here, the 1,073,000, meaning that 25% limits us at 268,000. So if you have multiple pension schemes, you might be over the limits. For example, you can only take out 268,000 as a total pension commencement lump sum. Again, a popular question I get asked is, let's say you've got two pension pots, they're both worth $500,000 each for round numbers. Sometimes investors will say, well, can I take all of my tax-free cash for the entire million combined from one pension scheme? And the simple answer is no. It's 25% of each pension scheme. Technically, the rules would suggest that every time you take a pension commencement lump sum from scheme 1, you have to notify scheme 2, and that's to ensure that they don't overpay you as tax-free cash. So just to show you how this has changed over the years, the rates of change have been drastic here. It's gone up, it's gone down, it's come all the way back round again. So you can see here how the standard lifetime allowance has changed over the last couple of years. So when introduced, it was 1.5, rose all the way up to 1.8, and then came back down again to 1.5, and has been slowly reduced down to 1, and then indexed slightly from 2016. So lots and lots of change in terms of the lifetime allowance over the last 15 or so years. Of course, all of these slides will be sent to you, so don't feel you need to rush to take screen grabs or anything like that. So apologies for the number of words you've got on the screen here. It's quite difficult to paraphrase some of these points I found, but it's worth noting that if you were an individual, going back to slide 12 here, if you're an individual who, let's say on the 6th of April 2012, let's say that you already had over a £1.5 million pension pot, and that's because you were operating in the lovely world of 1.8. You had 1.6 in your pension scheme for round numbers. You were fully within the legislative realms of the lifetime allowance, but the change coming in on the 6th of April 2012 has technically meant you are now £100,000 over your standard lifetime allowance. In that instance, the investor could apply for lifetime allowance protection. And there are namely 3 types of protection they could apply for: fixed protection, individual protection, and enhanced protection. I'm not going to go into the depths of what they are, but again, if you've got a pension scheme that is at these limits or above, please do get in touch and ask any individual questions, and I can answer them much clearer on a one-by-one basis. But for the sake of this presentation, I want to explain how the protections that individuals may have had are going to be looked at going forward. And the important one to look at here specifically is fixed protection. Now, fixed protection would be taken out if an individual was caught in that bracket. Their pension scheme is now subject to lifetime allowance charges because of a legislative change. That investor could apply for fixed protection. It would then protect their pension scheme at the historical lifetime allowance valuation, and therefore limit them being now subject to charges for being over the threshold automatically. For individuals with fixed protection, they were not allowed to contribute anymore to the schemes. So employer and employee could not pay in. So effectively, it's now a paid up pension plan. The only thing that could be changing is the growth and losses that occur behind the scenes. So again, one nuance with the change to the lifetime allowance is that protection is still in place. So if you've got a fixed protection and it's been in place from before the 15th of March 23, meaning the date of the spring budget, you can now start contributing to a pension scheme again. You don't lose your fixed protection, you can maintain that. But effectively, if you had fixed protection, you can now start contributing again without losing the protection allowances. What that means is that, let's say you've got 1.25 fixed protection from 2016, for sake of arguments, you start contributing into your pension plan again, they reintroduce the lifetime allowance, you've still got your 1.25 protection. So if you've got fixed protection, please seek advice. It's, again, quite a complicated area and difficult to paraphrase for sake of this webinar, but I hope that at least makes some sense, but please do get in touch with your advisor. Additionally, if you have got that fixed protection, you are not capped at the £268,000 pension commencement lump sum. You can take up to 25% of your protected lifetime allowance if above the pension value. Again, quite a complicated area, but hopefully that's useful. Okay. Lifetime allowance, for context, is tested at a couple of different events. Traditionally, for the kind of basics, the tests are when you take out pension commencement lump sum, when you turn 75, and when you die. The final test on death only occurs if you pass away pre-75. Effectively, the reason why we have those rules in place is that pensions as a broader asset has the protection of being inheritance tax free. So as per the current legislation, anything you've got in your pension scheme is outside of your inheritance taxable estate. Therefore, there is this risk that an investor could accrue money into a pension scheme, not spend from it, pass it on to their beneficiaries, completely free of tax. So the lifetime allowance test was brought in at age 75 to effectively capture those pension schemes that were of a very large size and therefore out of one's estate, and hasn't been captured via the test for crystallisation because they might not have taken money out. So there was always that initial test at date of retirement or date of crystallisation, test at 75 or at death should that incur before. The rules on this again have changed since the fact that the lifetime allowance has now been abolished. So whenever an individual passes away, their lifetime allowance is tested at that point if it's pre-75. And the test occurs on the deceased's lifetime allowance, not the beneficiaries. Very important to note that. And you have 2 years after an individual's death to distribute a pension scheme. And the actual benefit crystallisation event for lifetime allowance purposes is the date of payment, not the date of death. So for example, if you're an individual who received a pension in March 2023, and the payment hasn't actually gone in until May 2023, it's the May legislation we care about, not the March. And that is really important for any pension distribution that is occurring this tax year. Effectively, upon the abolishment of the lifetime allowance, the rules have changed in terms of that death test. So previously, if an individual inherited a pension over the lifetime allowance and they were taking it as income, they would pay 25% lifetime allowance charges on that withdrawal. That's now gone. If they were taking a lump sum, they would pay 55% lifetime allowance charges. That has also now gone. What is in its place is a test at income tax rates. So if you receive a pension, let's say it's 1.5 million, you're over the lifetime allowance as per the previous rules by around the 400k mark. That excess is taxed at your marginal income rate. So it's no longer taxed as the lump sum rules. If you're taking out as a lump sum, it's just taxed at income if you're taking a lump sum. I would stress that's only lump sums, so there is a bit of a loophole here. For example, if you went into inherited drawdown, you have no lifetime allowance charges. Even if it's 1.5 million, you're not paying any lump sums. If death occurred pre-75, you're not paying any income tax. So there is a bit of an argumentative loophole here that you go into inherited drawdown, you take the lump sum afterwards. Again, a very kind of difficult area of the legislation to paraphrase, but I hope I've explained that clearly. The key thing to note is that if death has occurred pre-75 and you are a beneficiary of a pension scheme over the lifetime allowance, there is the potential that there is still a tax charge to be paid. So please seek advice if you feel you fall into that bracket. Broadly speaking, however, the rules on death and pensions are largely the same. If you pass away pre-75, your beneficiaries get that pot entirely tax-free of income and inheritance tax. If you pass away post-75, again free of inheritance tax. But if your beneficiaries are drawing down from the scheme by way of a lump sum or an income payment or an annuity, they will pay tax at their marginal rate. In both instances, beneficiaries have an option to transfer their pension scheme they've inherited into their own. So if you are a beneficiary of a pension scheme, you're over and death occurred after 75, it may make more sense to retain the pension protection, move it into your own personal pension scheme, therefore retaining the inheritance tax relief and avoiding any immediate income tax charges for taking the money out. So that remains unchanged. But the key thing is just the lifetime allowance treatment and how that is a bit of an odd loophole that we are working through at the moment. Bringing me through to the future. Again, anyone who's sort of done any reading around the changes that have come in the spring budget will have seen that very quickly after the abolishment of the lifetime allowance, the Labour Party came out with the stance that we will reintroduce this. So it's difficult to view how short-lived this is going to be. Of course, opinion polls are suggesting that the Conservative Party are on their way out for the next general election. But again, opinion polls are opinion polls until we get voters on the floor. So difficult to judge. But if we do see a change in political party, it's very, very plausible that we will see another change to pension legislation. Specifically, the lifetime allowance, I think, is the point up for grabs. And if I take us back to my lovely pension stats at the beginning of the presentation, it is worth reminding ourselves that on fiscal GDP, the lifetime allowance is less than 1% of the government's revenue. So I'm, not showing any kind of individual opinions here with regards to my thoughts on the tax. It's just one of those things we have to bear in mind is a fairly low revenue driver for them. So, there's a lot of talk about how the lifetime allowance could be reintroduced. Argument one is we see it come back in its current form. We see the 1 million index to come back in. It's kind of business as usual as per the 22-23 tax rules. There may be some option for transitional protection for those who've had pension growth between the period where it was abolished and reintroduced. Again, if we've got an investor who is over the lifetime allowance as we've previously known it, we will give you very individual advice as per our recommendations for whether you should keep paying in. It's a bit of an individual discussion on your wider planning, in all honesty, but we plan for what we have at the moment, and that is the lifetime allowance is abolished. I've spoke to a couple of other industry professionals and attended quite a few professional sessions on how the lifetime allowance could be reintroduced, and the overwhelming consensus has actually been that it's quite unlikely we would see the lifetime allowance as we previously knew it come back in. There have been, for example, some really interesting arguments put forward that instead of reintroducing a cap on pension assets, they would almost force withdrawals. So again, all kind of up for grabs and just very theorised at the moment, but there is an argument that a political party may, instead of saying you can keep your pension assets in the pot, they might force a withdrawal at a certain age. Instead of a lifetime allowance charge, you've now got income tax on potentially some very heavy numbers, inheritance tax on the fact the money is now no longer pension wrapped, instead of our potential for a lifetime allowance charge. So there is a risk that we will see a slightly more complicated system in how pensions interact with the wider tax system of inheritance tax, income tax. But it is important to note with the lifetime allowance that it could come back in. It very likely will come back in. We just don't know what that's going to look like. It is very pie in the sky at the moment. Other areas that could change, tax-free cash. I think this is one of the most popular fears I found with investors is they'll get rid of the 25% tax-free cash rules. My argument to that will always be, I don't think that should stop anyone saving. I actually think that's probably fairly low down the priority list, in my opinion. However, I would bear in mind that if we had, say, a spring budget come in that introduced that from the 6th of April, we've got a window of activity. So given that we don't spark any money purchase on the allowance by taking out tax-free cash, it might be that we do a bit of an emergency withdrawal and advise accordingly, but I would not reduce your contributions on the fear of a tax-free cash removal, in my professional opinion. Additional changes could be around the annual allowance. As we've seen, that's changed multiple times in the last couple of years, so again they might change the rules there. And finally, they could change the tax relief. I think this has been reported really quite heavily since 2016 on and off. Will they reduce the tax relief on input? A couple of theorists argue that we'll see it come down to a flat rate of, say, 30%, meaning that additional rate taxpayers lose out on 15% relief, higher rate lose out on 10. So, there is the possibility they will reduce that. Again, if I take us back to our pension stats against the wider GDP, it's 1.8%. Yes, they do give us the tax relief on pension input, but it's not the biggest fiscal driver. So as the individual who doesn't hold a lovely red box and rules the Chancellor office, it's impossible to guess what they're going to do next. But it's just worth bearing in mind that whilst these changes have come in, they look great on the outset, your individual circumstances need to be applied. And what that means is that if you are a high earner, we have to be nimble with your pension contributions, meaning it needs to be an annual exercise to say what you're earning, what can you put in. We need to consider carry forward. We need to consider your possibility for change. By that I mean, when can you actually change an employer opportunity for contributions? Some employers only allow changes, for example, once every year in February. We just need to be nimble about the annual allowance changes. The same goes for the lifetime allowance. We just need to consider that if you are already over what was the lifetime allowance, we need to calculate the risk and the opportunity of you now saving into a scheme again. I don't think it should be ruled out as an option for planning. I just think we need to again be prepared for the what if we have legislative change. So in summary, we have seen multiple changes to pension legislation in the last couple of years, but specifically since the 6th of April, I wanted to highlight the annual allowance and the lifetime allowance, tapered annual allowance as well. So yeah, just important for everyone to hopefully get a bit of an understanding on those. Okay, a bit of a whistle-stop tour. I can see that Jess has messaged on the chat to ask for some questions, so I will run through those if everyone's happy for me to. Feel free to send any more in now just before we finish up. In answer to slides, yes, slides will get sent out automatically. If you've, my understanding is if you've joined the webinar, Jess will be in touch and send you over the slides, and there will be access to the recording as well, should you want to watch this back in your own time. With regards to earnings, I think this question is going to be talking about the annual allowance. If I come back to my slide here. Where are we? Yes. So the pension annual allowance is on relevant earnings. So the rules would be that relevant earnings are things like your PAYE income, savings income technically as well, but it excludes things like dividends and rental income. So if you've got, say, an earned income of 40k and you've got rental income of 40k, meaning total earnings of 80,000, you can still only contribute up to £40,000 because that's your relevant earnings for pension contributions. So unfortunately, on the contribution end, property income doesn't come into the picture on allowing how much you can put in. Where it does come in, because with all these things there is confusion, is regarding the tapered annual allowance. So again, if you've got your 40k annual earnings, but let's say for argument's sake you've got 300k of rental income, I'm not sure who would have that much, but just for my numbers, you have a total earnings now of 350, that does still reduce what you can put in. So whilst you don't get the annual allowance benefits of pension contributions for relevant earning, rental income for relevant earnings, it does fall into your threshold income calculations. So again, I would suggest anyone who has PAYE earnings and rental income earnings of 260 and above, please seek advice, and we can review the impacts on you, your planning there. Question on the money purchase annual allowance. This is a good one because it is a complicated beast, I have to say. If you are earning, so you've got your PAYE income, you're still in receipt of earned income and relevant earnings, but you've accessed a pension flexibly, meaning you've taken a flexible drawdown, you are capped at the money purchase annual allowance. So let's say, for example, I'm still working, but I've taken 10 grand out of my pension scheme flexibly. I can now only put 10,000 in a year, and that's me and my employer. However, the change comes in terms of if you've retired. So if you've retired or you have no earnings, for whatever reason, no relevant earnings, you are capped at this 36 figure. So they are similar in terms of how they work, but it's worth bearing in mind the money purchase annual allowance only applies if you're still an employed income source, basically. Hopefully that answers the question there.
Lovely. I don't think we've got any other questions coming through at the moment, but Kat, you are correct. So anyone who attends these webinars